Good morning, good afternoon, good evening, wherever you are in the world. Welcome to the monthly webinar series at the Energy and Commodity Finance Research Center here at ESSEC Business School in Paris. Today I am honored to introduce you with JOELLE MIFFRE. JOELLE is Professor of Finance at EDHEC Business School in Nice. She has been extensively publishing in the field of empirical finance with a major focus on commodity trading strategies and risk premium analysis. Her paper, Tactical Allocation in Commodity Futures Market, Combining Momentum and Term Structure Signals, has more than 5,000 downloads on the SSRN network. And today we are delighted to have JOELLE here presenting her recent contribution, The Pricing of Skewness in Commodity Futures Market, Risk or Lottery? So thanks for coming, please.
Thank you very much, Andrea, for your kind introduction and most importantly for having me here today at ESSEC. It's really a great pleasure to be here, an honor even. Welcome to all, wherever you may be. Thanks also to the participant in this room. It's really a pleasure for me to present you this paper, which is a joint work with Adrian Fernandez-Perez from Auckland University of Technology, Bart Frains from Auckland as well, and my long-standing co-author Ana Maria Fuertes from CAS. Here we're looking at the pricing of skewness in commodity futures market, and we're testing whether total skewness matters to the pricing of commodity futures. There are a strong rationale to think that skewness could matter. These reasons could be risk-based, based on the business cycle, based on the seasonality in the production and the consumption of commodity, or there could be lottery-like. There could be emanating from the behavioral literature. So we will look into those two reasons and try and bring an answer to the question as to whether skewness matters for behavioral reason or as whether it matters for risk-based reason. When it comes to risk-based reason or business cycle reason, we think that extreme level of skewness could be induced by seasonality in supply and demand, in production and consumption, by shock to the business cycle, or shocks to inventory. Indeed, the double-digit growth that we experienced in China at the beginning of this century led to a massive rise in the price of commodity futures contract, possibly inducing a positive skew in their return distribution. Similarly, dramatic events such as a drought or a hurricane, or an oil embargo, an earthquake, also could deplete inventory level, inducing sudden rises in commodity prices, and possibly, again, positive skewness in the return distribution of some commodity prices. Likewise, or vice versa, rather, sudden drop in demand following the debacle of Lehman Brothers, or similar to the one we experience now, could induce massive drop in commodity prices and negative skew, or abundant supply, for example, following the shale gas revolution, could also lead to skewness being negatively priced. Okay, so we think that there are fundamental reasons, risk-based reasons, to believe that skewness could matter to the pricing of commodity futures. We think also that there are behavioral reasons that could lead one to advocate for skewness being priced in commodity futures market in a way that has been shown to be priced traditionally in asset markets. It's been shown, indeed, in the theoretical literature that we, as agent, have a preference for positively skewed assets. As a result, these assets tend to be overpriced, and they subsequently underperform. Vice versa, we have an aversion for negatively skewed assets. We dislike assets who are subject to massive drawdowns. As a result, these assets are going to be underpriced, and they subsequently surprise us positively and earn positive mean excess return. Okay, so this is something that has been shown in the literature, theoretical literature on skewness pricing. Skewness has been shown from a theoretical standpoint to matter to the pricing of assets. With the higher the skewness, the worse the subsequent performance. And this, in fact, follows two seminal papers that you may have heard of. The first one is by Barberis and Yuang, 2008, and the second one is by Mitton and Vorking, 2007. These are two theoretical papers that conclude the same. The price of skewness risk is negative. The higher the skewness, the worse the performance of the asset subsequently. But, sure. In a way it is. In a way it is, indeed, because an asset that has been performing very well in the recent past is deemed to mean revert. That's why we can be hopeful these days that the price of crude is going to bounce, because we could assume, given the recent drop in the price of crude to experience negative skewness and to subsequently outperform. So indeed, there is probably a link between this skewness signal and some kind of mean reverting process. The theoretical literature here mentioned look at skewness and says, okay, skewness matters. There is a negative price of skewness risk. The way they approach the problem is different because they make different assumptions, right? Some will look at homogeneous preferences as described by cumulative prospect theory. This is Barberis and Yuang. And others, this is Mitton and Vorking, look at heterogeneous agents with agent with heterogeneous preferences, meaning that some are lotto players, they like positive skewness, they want to earn the lottery ticket, and other mean variance optimizer, a la Markovich, simple mean variance optimizer agents. And the coexistence of the two lead to skewness mattering when it comes to pricing assets. Okay, so we have this dual question. Is it driven by some seasonality and supply-demand imbalances consideration, or is the pricing of skewness driven by a lottery-like payoff? So we implement a large cross-section of time series and cross-sectional test that investigates this question, that investigate whether skewness matters to the pricing of commodity futures. And the conclusion is pretty strong, at least we like to believe that it is strong. Skewness command a negative price of risk, meaning that the higher the skewness, the worse the subsequent performance of the commodity futures. By doing that, we hope to contribute to two literature. The first one is the literature on skewness, the empirical literature on skewness, and the second one is the empirical literature on commodity futures pricing. When it comes to the first one, there is a lot of papers that have been written in the recent past as well as in the distant past that look at asymmetric payoff and the importance of asymmetry in pricing assets. So in the early days, we care about systematic skewness, as you know. That was with Krauss and Litzenberger or Harvey and Siddick. More recently, we cared about expected idiosyncratic skewness, which is shown to matter by Boyer and his co-author, commanding a negative price of risk. Total skewness has been advocated in the JFE very recently by Amaya and his co-authors to price equity using high-frequency data. Kuma as well had put forward a claim that total skewness matters. And this is due by the fact that many retail investors care about the lottery-like payoff that is embedded in a positive skew. They hope to win the lottery, in other words, by investing into a positively skewed assets. As an alternative for lottery-like payoff, Bali and his co-author looked at maximum return. And that's quite interesting because they say it's not so much the total skewness that matters. In fact, it doesn't if you include in your regressions maximum return in the recent past. Okay, so it's the preference of agent toward maximum return that is price, and not so much their preference for positive skewness. Risk-neutral measure of skewness have been used as well, that are implied from option prices, and they've been shown either to price equity or to price equity derivatives, equity options. Okay, so the debate is really well documented when it comes to the equity market and the equity option markets. Skewness matters, so we investigate whether it does in commodity futures, and our conclusion is very much aligned with the conclusion of those people. We contribute hopefully as well to the commodity futures pricing literature. This is something that I think is fascinating. I hope you will share my enthusiasm. It's really something that has been discussed ever since Keynes 1930, so it's a very, very long-lasting literature. But this literature thus far mainly centered around the theory of storage and the hedging pressure hypothesis. So we hope to contribute beyond these key factors by showing that, well, we should price commodities, including a skewness measure. Okay, that was a rather long intro. Please. Yeah. Using the skewness, the total skewness. So if you spare me a few slides, here it is measured. So we measure the total skewness looking at daily data over the past 12 months. We also looked at whether it's systematic skewness, idiosyncratic skewness, or expected idiosyncratic skewness that matters, because the literature abounds with quite a few measures. So we were not sure up front, ex ante, as to whether it would be total skewness that matters or not. But in the end, it's total skewness that matters. So we tend, in the later draft of this paper, to omit the alternative measure. Yes.
In 2012 paper.
It's true, Gorton and Rouvenhorst, in their 2006 paper, if my memory serves me right, have shown that their long-only equally weighted portfolio of all commodity presented a positive skew, and indeed that was something that the industry loved, because it was a very strong selling point for a long-only position in commodity futures market. My contention is that even for the long-only portfolios, the evidence are not that strong. And from doing this experiment, I now believe that it's important to look at different type of commodities, but because not all commodities are going to be positive or negatively skewed at one point in time. And it's important also to look at skewness over time. So I very much agree with your point that skewness is something that is time dependent. Okay. For proof, if needs be, I would assume that in 2008, crude was positively skewed, and now it's most likely negatively skewed. Okay, so the point of the paper is to show, of course, that skewness matters to the pricing of commodity futures, but it's also to show that by modeling skewness, we are modeling something that is not related to what is known regarding the pricing of commodity futures, right? So the risk premia we're capturing, we hope, is somehow orthogonal to the risk premia that have been shown to matter in commodity futures market. And the best way, I think, to do that is to place first our discussion in the context of the literature when it comes to commodity futures pricing, and then to show that, yes, what we're capturing is hopefully not what was captured before. I'm sure you're familiar with this graph, so I'll go fast, because this is a graph that shows simply the fundamental of commodity futures pricing. At the bottom, you have the evolution of the futures price in backwardation in blue for nearby contracts that mature at time N and a distant contract that mature at time D. And in red, you have the opposite, the evolution in a contango contract. So clearly, as an investor or as an academic wanting to model the risk premium in commodity futures market, one needs to buy backwardation and short contango. How do I know at time zero which assets are backwardated and which are contangoed? Well, it's just a matter of really reading the literature, really, because the literature abounds with signal that tell apart contangoed from backwardated market. So the literature, for example, advocates the fact that a backwardated contract is one with a positive roll yield or with a downward sloping term structure of commodity futures prices. It's one that has low inventory, scarce supply. Going back to Keynes, it's a market for which hedgers are short and speculators are long, on average. And it belongs to the momentum winner portfolio. So it has good past performance, and it's hoped to perform good in the near future. So I want to buy those assets at the bottom, and clearly the signal are reversed for a contango market. So I want to short the contangoed assets that have negative roll yield or upward sloping term structure of commodity futures prices, high inventory, for which speculators are short and hedgers are long, and that belong to the loser portfolio in a momentum strategy. The literature, as I said, is very, very long-lasting and still very active. It's both theoretical and empirical. When it comes to the theoretical literature, it goes back to the theory of storage of Kaldor, Working, and Brennan, or it goes back to the famous hedging pressure hypothesis of Keynes, as generalized by Kuttner and Hirschleifer. That's for the theory. You have also plenty of empirical papers that support empirically this theory. Of note, maybe those of Gorton and Ruvenhorst with Hayashi in the ROF, where they show that inventory level are key to detecting whether markets are backwardated or contangoed. Low inventory comes hand in hand with backwardation. High inventory comes hand in hand with contango, as hypothesized by the theory of storage. Of note as well, the papers by Herb and Harvey and Gorton and Ruvenhorst that you were citing, where they look at term structure and they use the slope of the term structure as a signal for asset allocation to model the risk premium in commodity futures market to buy backwardation and short contango. The hedging pressure hypothesis also is supported empirically. Bessembinder and Chang spring to mind. In 2013, we wrote a paper that looked at hedging pressure as well, and that highlights the fact that if you systematically buy backwardated assets for which speculators are long, and short contangoed assets for which speculators are short, then you end up again modeling the price of risk, the risk premium present in commodity futures market. Momentum, well, this is more ad hoc, I suppose, right? Because when you buy momentum, you buy the past winners. And when you short momentum, you short the recent losers. So there is no correlation ex ante, at least, between momentum and the theory of storage, or between momentum and the hedging pressure hypothesis. But it's been documented, among others, by Etherington recently in the RFS, or again Gorton and Hayashi in the ROF, that the winner in a momentum portfolio have characteristics coming from the theory of storage or from the hedging pressure hypothesis. So when you buy the winner, in fact, you're buying backwardated assets for which speculators are long and for which inventory are low. When you short the loser, you short contangoed assets for which speculators are short and inventory are abundance, among others. Okay, so we model the risk premium present in commodity futures market by using the signal that we think are fundamentals to the pricing. To do that, we sort a cross-section of 27 commodities, trading only front-end contracts up to 1 month before they mature, then rolling to the second nearest contracts. The data come from DataStream, and the sample starts in 1986 because we need the position of hedgers and speculators, as disclosed by the CFTC in the Commitment of Traders report. And these data only were reported from 1986 onwards. As well, the cross-section is driven by the CFTC data because there are only it's not bad, but there are only 27 commodities for which hedgers and speculators have to report their positions. So that's the limitation of the sample. Out of these 27, clearly we want to buy those in backwardation, shorts, those in contango. So we form quintile that are long, short, based on either one of those three signals. And this is really following the literature. So we look at roll yield over the recent past. We buy the 20% that have the highest roll yield, short the 20% that have the lowest roll yield. We look at past performance, buy the winner, short the loser. And we look at hedging pressure. We buy the 20% for which hedgers are the shortest and speculators the longest, and vice versa. We short the 20% for which speculators are the shortest and hedgers are the longest. Okay, so this is really a spin-off of Keynes and Kuttner. We end up with 3 long-short risk premia, clearly, and because we follow the literature, we also include long-only equally weighted monthly rebalanced portfolio of all commodity, which is the one I suppose you were referring to earlier on, which is a traditional 1/n portfolio as applied to commodities with monthly rebalancing. Here are some summary statistics regarding the performance of our risk factors. Mean excess return annualized, standard deviation annualized, and Sharpe ratio. Well, as is very well documented in the literature, it's good to be long short in commodity futures market if one wants to earn a good Sharpe ratio. The Sharpe ratio range from 38 to 61 if you're long short, with a mean excess return that is positive and statistically significant. I would not... No, annualized, yeah. I would not recommend to go long only, although many people would do that, since the performance is clearly bad if you assume that markets are backwardated only, right? That's what the long only portfolio does. The correlation at the bottom shows that, well, the correlation are not massive. They range from 2 to whatever, 30. So we hope that none of the factors is redundant. So we have this 4-factor model, if you wish, and we want to test whether skewness matters beyond these 4 factors that the literature says do matter. And we do that by implementing first-time series tests. So bouncing on your question from earlier on, we measure the total skewness of each commodity using the standard measure of skewness and using daily data over the past 12 months. We do that for our 27 assets, and we sort our cross-section into 5 quintile, where P1 include the 20% with the lowest skew, the most negative skew, and so on and so forth, up to P5, which include the 20% with the highest, most positive skew. We do that every month. We hold the portfolio for a month, we sort again, and that's, of course, roll until the sample end. And here is a summary statistic regarding the performance of the transformed portfolio. We also form, as you can see on the right-hand side, a P1 minus P5 portfolio that buys clearly the assets with the most negative skew and short the asset with the most positive skew on a fully collateralized basis. So we do not assume that there is any leverage. That was the case for the risk premia as well. Well, it's quite interesting to note that you see P1, the portfolios that include the most negative assets, skewed assets, tend to outperform, which means that given our aversion for negative skewness, we tend to underprice these assets and then subsequently surprise us positively. They subsequently earn a positive, non-significant, but 5% annualized mean excess return. Performance decreases monotonically, here you can see, as skewness rises. And in fact, if you look at P5, it has a very positive skew and a very abysmally low mean excess return at minus 11%, significant at 1%. Okay, so that goes very well with the literature that says, given our preference for positive skewness, we tend to overprice those assets, and they subsequently perform very poorly. If one buys P1 and short P5s on a fully collateralized basis, one ends up with a mean excess return at 8%, significant at 1%. As I said, this P1 minus P5 portfolio is fully collateralized, and that's quite interesting because you get a hedge that is embedded in those long-short portfolio, so much so that the volatility of the portfolio is rather small. It's only at 10%, which is less, of course, than the others' volatility, simply because I go long-short, so by construction, the shorts are going to hedge the risk that the long could depreciate and vice versa, so I'm getting not a full hedge, but a partial hedge. One can see that as well looking at the drawdown. The drawdown is quite massive, 29, but it's not as bad as it could be on the other portfolio. So altogether, we end up with a Sharpe that is quite nice. The Sharpe is mentioned here, is at 78, and it's higher than the Sharpe on the other portfolios that I presented so far, on TS, on momentum, or on hedging pressure. Well, we wanted to find, please. We did that. We did that and it did not work. We did everything. Once you have the code, it's easy to change the sorting. So we did variance, we did skewness and kurtosis. And the results were not conducive to anything that was worthy of publication. So in another paper, we did a sorting based on idiosyncratic volatility. So not on total risk, but idiosyncratic volatility. And this was following a paper by Hank, Roderick, Xing, and Zhang that you may be familiar with that shows that high idiosyncratic volatility stock perform very poorly. And we saw that as well in commodity markets. But when it comes to total risk, not idiosyncratic risk, I don't recall anything good. So we forgot altogether. We didn't follow suit. But I mean, I'm happy to dig the codes and share with you the results in more detail, if you so wish. So idiosyncratic volatility did matter to some extent. It was not super convincing, but total risk was not a good signal. Kurtosis doesn't work at all. Okay, so this is very standard. What we do is here we regress the excess return on each of the skewness sorted portfolio on our four-factor benchmark, the 3 long-short portfolio and the long-only portfolio, in an attempt simply to explain the performance through exposure to the risks that matters in commodity futures pricing. Maybe what is worth looking at is the first row where we report the annualized alpha. So again, it's been annualized. And you see the monotonic pattern appearing here as well. The higher the skew, the worse the alpha. P1 earns 4% annualized, significant at 10%. And again, P5 loses a lot, 9%, significant at 1%. Okay, so again, that could be due to our preferences of for positive skew and our aversion towards negative skew. On the right-hand side, you see the alpha of P1 minus P5 is at 658 annualized. It's quite interesting because you see the total return excess return was at 8. The alpha is at 658, suggesting that 150 roughly corresponds to the payoff, to the exposure to risk as modeled here. And a massive 6.58% is an alpha unrelated to the sources of risks that matters in commodity futures market. So that led us to believe that maybe it's due to our preferences for lottery-like payoff. It's more a behavioral story that underpins the pricing of skewness, and not so much, as I thought initially, I must confess, a risk-based or business cycle story. We do plenty of robustness tests. I hope I'm fine. plenty of robustness tests to check whether it's really a behavioral story that holds the key and not so much a risk-based explanation. So for example, we remove from the futures return on the left-hand side the influence of seasonality. We add monthly dummy for production and consumption. We remove the 4 factors influence and the influence of the business cycle, where the business cycle we use, well, the usual suspect, plus the change in the Baltic Drag Index, because we're doing commodities, so it makes sense to use that precisely called proxy for the business cycle. What we do, once we have done this regression for each commodity using the past 12 months of daily data, we save the residual, measure their skewness, so that's idiosyncratic skewness if you wish, and sort P1 into the commodities into P1 and P5 portfolio by P1 short P5. And here is a performance of the then generated portfolio. As you can see, the performance is a bit less good. The alpha has dropped. The mean excess return is a bit less compared to the case when I sort based on total skewness. So if I sort based on idiosyncratic skewness, performance decreases, but it's still positive and statistically significant. So that suggests to us that probably the pricing of skewness is not driven by the fundamentals. It's not driven by the seasonality that we know is important to commodity pricing, or by the influence of the business cycle. It's not driven by the fact that we have abundant supply now in the crude oil market and very, very much lower demand. We implement a similar strategy as well on 2 subsamples. So this is commodities that are deemed to have strong seasonality in supply and demand, in production and consumption. And these are the commodities that are deemed not to be seasonal, the metal. And we we run P1 minus P5 based on skewness, and you see the performance is still good, even for the non-seasonal commodity. So that suggests that skewness matters for a reason other than seasonality, at least to us. And if it's not business cycle based, then possibly it's because of behavioral consideration. We run a battery of time series tests as well that look at liquidity and transaction cost. Well, simply, yeah, of course, when I buy P1 and short P5, it costs money. Not so much, to be honest with you, because in P1 you have 5 assets, in P5 you have 5 assets, and the cost of trading in futures market, as you know, they are really, really very small compared to, for example, buying a small cap. Okay, so we need to knock down performance by the cost of trading, but as you can see, the inferences are the same. Likewise, we say, okay, maybe you capture liquidity risk premium by buying P1 and shorting P5. So we look at the impact of lack of liquidity on performance by removing the 10% that are the least liquid and implementing the strategy on the 90% that are the most liquid. If it's a liquidity risk premium that we're capturing with P1 minus P5, the performance should be low now in the first row. It's still good, so it's not a liquidity risk premium that we capture in the first instance. It's something that is therefore possibly related to the preferences of agent for skewness. So far we rank based on the past 12 months of daily data and hold for 1 month the long-short portfolio. Well, let's look at if we use the past 6 months to the past 96 months of daily data and measure the skewness based on these examples, holding still for a month. And you see, well, it's not necessarily as good as here, which is our base case, but it's pretty robust. Bold, by the way, means significant at 10%. So if it's bold, we're happy, roughly. We changed the holding period. So far, the holding period was 1 month. We hold up to 12 months. It's true that performance deteriorates, suggesting possibly mean reversion eventually here, but it's robust up to 6 months. And we split the sample into subsamples. This is totally standard. So just to see robustness of the P1 minus P5 portfolio over different subsamples. So this is splitting in half. This is splitting around the financialization of commodity futures. And that's when I split around the financial crisis. And with the exception of that period, it seems okay. So that's for the time series test. That shows that we should basically buy negative skew and short positive skew. Let's look at the cross-sectional test. They are very standard, so I'm sure the methodology will be familiar to you. Just a cross-sectional regression with some control variables. So we first measure the skewness of each commodity at the end of each month using the past 12 months of daily data, and regress those skewness, regress the excess return of each commodity, that's the first cross-sectional regression, on those skewness. That gives us a price of skewness risk, lambda sk, and we do that recursively until the sample ends. That gives us a time series of prices of skewness risks. And we test the significance of lambda sk using New and West correction. Then we augment, that's the equation number 2 on the board. We augment the first cross-sectional regression with a vector z, it, where this vector z, it, is either here to explain the commodity futures contract or here to explain the skewness. And we test whether the inferences are robust to the inclusion of this control variable. So what are the control variables? Very, very standard. They come from the commodity pricing literature, so it's the same as before, raw yield, past performance, and the hedging pressure. And they come as well from the lottery-like literature, because as you may remember at the beginning of the presentation, I said there are quite a few measures of asymmetry that matters. So it's been shown that assets with positively like payoff have low price, so we use price as a control variable. They have high idiosyncratic volatility. So we use idiosyncratic volatility as idiosyncratic volatility as a control variable. This follows Boyer, Mitton, and Voking. It's quite a nice paper, actually. I strongly recommend you read it. It's because they argue that the idiosyncratic volatility puzzle can be explained through skewness. So we say, okay, maybe when we include skewness in our cross-sectional regression, we should in place include idiosyncratic volatility. And maximum return, this is Barley and his co-author, GFE. Well, they say, no, it's not skewness that matters. It's the fact that the performance was very, very good in the recent past. So we do that, and then we run a third set of cross-sectional regression that is even more standard. It's just Fama-Macbeth, two-step approach. And in the second step, we have the estimated beta of each commodity excess return to the 4 commodity risk factors. They equally weighted, the term structure, the momentum, and the hedging pressure. And again, we test for the pricing of lambda sk using Shanken correction this time. Okay, so this is full of number. Let me bring your attention to the one that matters, and we can discuss, if you wish, the one that matters less. Possibly the row to look at is the second one that portrays the price of skewness risk from different specification of the cross-sectional regressions. The nice feature is that the price of skewness risk are always negative and statistically significant, irrespective of the specification considered. So it holds if you include the control variable coming from the commodity literature. It holds if you include the control variable coming from the skewness literature, if you include both, and also if you include the sensitivity of each asset to the 4-factor model. So that's column 5, it's really a Fama-Macbeth regression. Interestingly, and I was surprised by that, because I always strongly believe that yes, momentum and hedging pressure should matter cross-sectionally. I was surprised to see that they do matter, but only marginally at 10%. And what matters most is skewness. So that suggests that possibly when pricing commodities, we should go beyond the usual suspect. We should possibly include a proxy for skewness because it recommends a price of risk that is highly significant. It's true, on its own, it doesn't matter much. The R square is at 1.22, but in conjunction, it should not be omitted nonetheless because it commands a very negative t-stat. Again, we run robustness checks. The conclusions are more or less robust. I mean, I'll leave it to you to appreciate the extent of my more or less. First, we do like we did with the time series test. We regress each commodity futures return on seasonal dummy, and then on seasonal dummy on the risk factors and business cycle variables. So it's again the same with the Baltic dry index among others variable. We save the residuals, we measure their skewness, and we test whether idiosyncratic skewness is priced. Whether the skewness of the residual explains the subsequent commodity futures return. And again, it's negatively priced. Okay, maybe less so here. This model, shows you the prices of skewness risk. So it shows you this column, the second row, pardon me, in reference to that column, in reference to model 4. You see the prices of skewness risk are still negative, at least at 10%. And this shows you the prices of skewness risk in reference to model 5, in reference to this column. So when we include the sensitivity to the risk factors. And we find out, well, skewness still commands a negative price of risk. Less so, it's quite interesting to see that statistical significances drop, suggesting that part of the skewness pattern relates to business cycle variable, relates to the fact that China was consuming a lot of commodity in 2000 and consume less commodity now. But the pattern is still there, so to some extent it's unrelated to the fundamentals as well. We use various asset pricing models, among others CART, Barclays augmented with CART. The prices of risk are, these are the prices of risk, of skewness risk. They are still negative. Even more negative, which is probably not surprising, because if I use the wrong asset pricing model, the pattern should be stronger. If I don't capture at all the fundamental of backwardation and contango, the pattern should be stronger, and indeed it is slightly stronger. We look at different ranking periods over which skewness is measured. The results are best for the ranking period of 12. That's why the paper is articulated around this ranking period. Less robust here for if you use as in your cross-sectional regression the control variable of model 4. And the prices of risk are still very negative and significant if you use in your cross-sectional regression the beta from the first step of Macbeth. And the subsample analysis, well, I'll leave it to you to appreciate the extent of robustness, but at least we were happy to see the negative signs for the price of skewness risk over the different subsample. It's negative, it's not necessarily significant in the latter part. So the price of skewness risk seems to be undistinguishable from 0 here, here, and there.
Maybe if you take out the crisis there, no?
Which period?
Because
Yeah?
until July 2007, you have, it's that gold is statistically significant,
Yeah?
but between August 2007 and if you exclude the period of the crisis, because there's a lot of anomaly in pricing.
That makes sense, yeah.
Yeah, just to.
So we would expand this sample a bit,
Yeah,
and we will shorten that sample a bit.
Middle 2009, you find a lot of mispricing on futures on that.
And that's an interesting point. Indeed, because it's hard to know exactly when to split the sample. And one could very well advocate that we should push that by a year, possibly after the debacle of Lehman Brothers, and see whether the pattern still holds. Yeah, thank you. Thank you. We follow, can't remember, Bruno Meyer, I think he has written a paper on the crisis, and he split at that date. But there is no consensus with regards to when the split is better. So yeah, we will take your point on board. Thank you. So yeah, this is just a PowerPoint to conclude. Initially, I thought, to be honest with you, that skewness was driven by fundamental, because, you know, we are rational economists, aren't we? So we'd like to believe that the asset pricing model is going to be key to understanding everything. The result forces me to acknowledge that it's not the case, right? It's more a behavioral pattern in line with a large theoretical and empirical equity literature. It's a behavioral pattern that seems to hold the key to why skewness matters in commodity futures. And that, I think, is quite interesting, because if you read the paper of Kumar, he says, that skewness matters because of retail investors that like politically skewed assets. Clearly, I don't see a retail investor investing into a pork belly futures contract. So it's quite interesting to see that skewness could matter on derivatives such as commodity derivatives, for which in which retail investors do not trade, in which the majority of participants are either hedgers or speculators, but in which retail typically don't have a role to play. Okay, so that suggests that possibly there is a role for skewness beyond the role advocated by Kumar, beyond the role advocated maybe by Barbares and Yuang. When they look at heterogeneous agent, then the heterogeneity might be broader than we had thought initially. Thank you.
So thank you very much for the presentation, first of all. Just one question in general about the approach. So that reminds me a little bit of pairs trading, when you short sell an overvalued stock and you long an undervalued one, the overpriced one. Do you have any links with that? I mean...
Yeah, thank you. Thank you. This is a fair point. To be honest...
because in my views, like you are saying that when the skewness is positive, you short the asset. When the skewness is negative, you expect it to grow, so you long it. That's the same thing that you do basically for pairs trading. So I don't know whether...
My understanding of pair trading is that there is more commonality on the long leg and the short legs than there is here, because I may end up shorting crude and buying pork bellies. So, you know, the long and short leg have little in common. But it's a very fair point to make. That reminds me of the comment you were making regarding mean reversion earlier on. It's broader, your comment, in as much as I only go long the negative skew. But there is some mean reversion that is embedded, that is captured by pair trading as well. So it's a comment that we haven't focused yet on. And we could look at how the payoff of a simple mean reverting strategy or pair trading strategy compared to our skewness approach. So thank you for raising it.
Therefore, if I understand correctly, you're generalizing by saying that even if you don't take two assets that are supposed to be very highly correlating, then you still find alphas. Okay, that's interesting.
True.
Okay,
that's true.
Thanks a lot.
I mean, commodities are known to have low correlation among themselves. So, yes, indeed, if I may buy crude and short corn. Mind you, crude and corn are correlated now. Now that ethanol is kicking in, possibly the example is not good. But indeed, the two assets underlying typically have little in common.
Question for you, Joëlle. Do you think that it might be worth of studying whether this skewness factor enters, and if so, to which extent, option prices? Which basically amounts to saying, well, under the historical probability, we have been able to unveil some factor which cannot be explained by other observables. And while we move to the risk neutral measure, the market price of risk, which according to what you said, still contains that factor, does not offset the importance of this factor, and therefore option prices include this skewness effect. It might be worth perhaps of studying this first statistically, and if there is some significance, this link, well, the next step would naturally be to include that factor in an arbitrage pricing model. Has this been done, or what do you think?
Not to the best of my knowledge. I think that is a very worthy test to run. I'm not as well versed on the literature on option pricing in commodities than you are, so maybe I'm less placed to argue. From my understanding, it hasn't been done, but given how well it works in the equity literature, then my suspicion is that it should be working as well. It would be interesting, bouncing on what you say, to test the extent to which this skewness implied from option prices, from the risk neutral probability, overlap with my skewness measure. Maybe the two capture different patterns that are important to pricing. To the best of my knowledge, it hasn't been done. What we have done, though, is look at high frequency data for skewness, so run exactly the same test. The results are way too preliminary to be confident in discussing them. So, you know, it's a paper that will come up in 2-3 years if we're lucky. But so far the results are not convincing. So high frequency data don't convey enough information, at least from our preliminary result. Option pricing we haven't looked, but I trust your judgment. I think it's a worthy empirical test to run. It works in equity, skewness works in commodities, so it seems like there is a lot of overlap here.
Thanks. Okay.
Thank you very much.
Thank you very much, Joëlle.
Thank you very much. Thanks for having me as well.